Here, in short, what private equity is in Canada and the different options available to Canadians to investing in alternate investments instead of the banks. Hi, everyone. I've got Kyle from Equiton Capital. So basically today we're going to talk about private equity, what the banks don't want you to know as a Canadian or as an investor. So typically speaking, when we talk about private equity, we always think that it's for the top 2% of Canadians that can invest in a product like ourselves. But the reality is that it's open to the public, and it might be a little bit longer process to move your money around from a bank institution to a private equity group, but the results are definitely different than a bank. And also there's a lot more upside in investing in private equity if it's on the real estate side of things or other different offerings. But today we're going to talk to Kyle Equiton about his 2 cents on that.
Yeah, so I'm Kyle Argo with Equiton Capital. We're a private real estate investment firm. And really, I want to talk to you about some of those topics that Matt was talking about right there. So just kind of bringing it back a little bit, private equity, really similar to public markets, except that we're not listed on a stock exchange every day. And prior to 2016, legislation in Canada was so that only high net worth individuals as well as institutions could get involved with these type of investments. It's just not the case anymore. Again, 2016, they changed the legislation, so everyday Canadians can get involved in this. We like to think of it as the best kept secret in the investment world right now, because not a lot of people know that they can have access to these institutional grade investments that just weren't available before. Really, who can invest? Everyone can. But there's certain criteria through the CRA that people need to essentially qualify for. But really all it does is it stipulates how much you can invest. So really quickly, just going over that, accredited investors are like the top of the food chain. They can really invest whatever they want in this space. To be an accredited investor, you have to meet one of these 4 different stipulations. So you either have to make $200,000 on your own, make $300,000 as a household, have net financial assets of over $1 million, or have a net worth of over $5 million. If you're an accredited investor, you have no limitations to what you want to invest in private equity. Don't worry, if you don't qualify for that, like most of us, the next one down is what's called an eligible investor. So if you qualify as an eligible investor, you can invest up to $100,000 per 12-month period within the private space. When I say 12-month period, it's not January to January. If you did it today, which is February 24th, you'd have to wait to February 24th next year to do another $100,000. To qualify as an eligible investor, you have to meet one of these 3 categories. So either make $75K on your own, or $125K as a household, or have a net worth of over $400,000. Now that includes equity you have in your home, all of your financial accounts, all of that stuff added up. So that's the threshold there. Even if you don't qualify as an eligible investor, you still qualify as what's called a non-eligible investor. Don't really like the terminology that they use because it's misleading, but you can still invest up to $10,000 in private equity per 12-month period. Looking at the banks and how they kind of treat things, when they put you in a diversified portfolio or a balanced portfolio, usually what they're going to give you is a mix of fixed income and equities all wrapped up into your portfolio. They'll do subsections there like industrial, commercial, tech, those type of things, but it's likely all public markets. A new paradigm coming around that we've noticed trends going is more and more people are investing into the alternative or private equity because it adds predictability, stability, lowered volatility, and really true diversification to your portfolio. We like to follow the Canadian pension plans. The reason why these are typically the most savvy investors in the country and they literally have a fiduciary responsibility to their pensioners that money's there for them to retire. So they need to limit volatility and be able to pay people's pension. If you go all the way back to 1995, they only had about 5% of their books allocated to private or alternative markets. If you fast forward all the way to 2020, they're all the way at 40% of their book being in this space. So again, that really just goes to show that predictability, stability, lower volatility, and true diversification that you really get out of the private equity markets. We like to look at certain trends as well. When you're looking at Canadian equities, a TSX index, usually what you see is something that looks like this: up, down, up, down, up, down. It's really the roller coaster ride of the public markets. How much money you make off an investment is more important for when you actually need to get out than when you're actually putting your money in. And what I mean by that is usually everybody's saving or putting their money away for something. Maybe your kid's going to school, maybe your retirement, maybe you want to buy a house, maybe you just want to buy a boat or a Ferrari or change your lifestyle, anything like that. So heaven forbid the markets were in a down year, because then you're stuck between a rock and a hard place. Either you're going to have to find money somewhere else, you're going to have to wait it out, those type of things, but it's just not convenient there. And if you look at any of their traditional guaranteed investments that they call them, like GICs or bonds, very, very little money to be made after inflation. You're probably not making anything, if you're even making anything at all. When you go over to the private side, or the Canadian Private Apartment Index, it's never had a negative year in over 35 years since they've been tracking it. Never. That includes all of through the last 4 financial crises. So the tech bubble, the Russian bailout, the financial crisis of '08, and even held through COVID today. Never had a negative year. It's been consistent year over year through that. So I like to do a really quick comparison from Canadian equities with the Canadian Private Apartment Index quick, okay?
And maybe talk also about, what an average, return at a bank versus what
That's exactly what I was just about to do. So I want to compare the averages for Canadian equities, which is Canadian stocks, those type of things, versus private equity, the Canadian Private Apartment Index specifically, okay? So if you were to put your money in Canadian equities for the past 33 years, your highest year over year return that you would have had was 35%, which is awesome. The lowest year you would have had, though, was negative 33%. So that's a huge swing, that volatility going up, down, up, down, up, down. On average, from over the last 33 years, you would have averaged 9.55% if you were invested in this market, okay? If you go over to the Canadian Private Apartment Index, the highest year you would have had, very respectable, 22.3%. Not quite the 35 that you have on the equities, but let's look at the low end. The lowest you would have got is 1.7%. That's even during financial crises. Now you look at the law of averages, which one would you have ended up more with? If you look at the Canadian Private Apartment Index there, you would have had an average of 10.3%. So I don't care who you are as an investor, you have 2 goals in mind when you're investing in anything. 1, you want to make as much money as you can. 2, you don't want to lose anything. You want to lower your volatility. So if you could have invested in the same thing, not had the ups and downs, and still came out on top, it's a no-brainer that you should at least have some of your money allocated into this market.
Awesome. That's awesome information.
Mm-hmm.
So you guys have it here in short, what private equity is in Canada, and the different options available to Canadians to investing in alternate investments instead of the banks. Maybe we could talk about, how the banking system doesn't really like guys like you and I when it comes to moving clients' money around, how they make the process maybe a little bit longer, or just all the hoops they have to jump just to take a bit of money out. And especially with registered funds, they don't like the money moving around that way.
Yeah, especially in registered, it can take all the way up to 12 weeks And that's because they're really trying to do anything they can. I always joke around with people and I say they don't want to take their greedy little paws off of your money, but this is your money. So the big five banks, they don't work with private companies. They only work with the companies who are paying the money to have their product on their shelf and those type of things. So they try and do everything that they can to delay the process to take the money out, because really what they're doing is they're holding your money and they're earning interest off of your money, and they're not giving you a whole lot in return. So we work with a company called Olympia Trust specifically. They are a custodian who can hold registered monies. And sometimes it takes, again, all the way up to 12 weeks when we send transfer paperwork out to transfer the money from the big five into a custodian like one of those trust companies who will allow you to invest in private markets.
All right, guys. So if you guys are looking to get in this type of an alternate investment, I'll have Kyle's information contact below the video and the link. If not, you can reach out to him on social media, on LinkedIn, and you can reach out to myself also if you have any questions. Thanks again, Kyle, for being our guest today.
No problem at all, Matt. Always happy to shed some insight, and I appreciate you having me as a guest on here. Had a lot of fun talking about it today.
All right. Thank you.